Next up is Aaron Archibald, who's the Vice President of Sales and Strategic Partnerships at CO2 Gro. CO2 Gro is listed on the Venture Exchange with the ticker GROW. Gro creates a saturated CO2 solution that, when misted onto plants, has the ability to increase yields by up to 30% and profits up to 100%. I've been following this company for a number of years, and I think this technology has enormous potential. So I'm looking forward to getting an update from management. Hi, Aaron. How are you?
Thanks, Tina. How are you doing?
Good, thanks.
Thanks for the great intro. I'm not sure I'll need to say anything now.
Try to be thorough.
Yeah, I will. All right, I'll get started. I'm Aaron Archibald, and I am the Director of Sales, Marketing, and Business Development for CO2 Gro. We're an early stage precision ag tech company. There will be some forward-looking statements made today, so please refer to this guidance document here. Our mission is to revolutionize the protected ag market, and that market is 600 billion square feet. Only 50 billion square feet of that is in sealed glass greenhouses, which leaves 55 billion square feet in open-ended hoop houses, shade houses, semi-protected grow, which is really low-hanging fruit for us as a company. Again, we're a precision ag tech company, and we bring a unique method of delivering CO2 to growers. And what we do is we dissolve high levels of CO2 in a stable water environment, and we mist that onto plants. The plant leaf surface acts as the receptor for the CO2 versus simply the stomata, which is usually found on the underside of the leaf. Our focus is on protected ag crops of high value like peppers, tomatoes, berries, leafy greens, cannabis. And our target area is really 40 degrees north and 40 degrees south of the equator. One of the reasons that we focus on 40 degrees north and 40 degrees south is that 90% of the world's population lives within that region, and most of the food that we eat is grown or produced within that area. So we can bring value to areas that are producing most of the food. So it is a common sense market for us to be in. One of the reasons we've chosen peppers, tomatoes, berries, leafy greens, and floriculture as key target markets is that they are the highest value crops grown in a protected ag space versus things like corn that's grown in open fields and has very little commercial value. So we focus on North America and Central America as we're a Canadian company and it's our backyard. We also have strong ties in the UK and Western Europe with sales offices there. We also have support and infrastructure facilities within that region so that we can easily tackle projects. And we have a strong value proposition to our customers who are all growers. We bring an increase of up to 30% in yield production. We also provide a natural plant protection against pathogens. One of the reasons we do that is as we dissolve CO2 into water, we drop the pH. As that solution is misted onto the plants, the CO2 is taken into the plant, which creates a constantly fluctuating pH on the plant surface. So things like epithetic and micropathogens just cannot get a foothold there. Between the crop savings and the increased crop yields, many of our customers are seeing a doubling in their profits, gross profits, that is, as we have very low operating costs. We also offer flexible financing terms, and we usually see a 3-month to 2-year payback depending on the type of crop that our customers are growing. This is a perfect example of a customer, a large commercial grow customer that can't currently use CO2. That is currently before they found our system. They're a pepper producer in El Salvador. They have one of these covered shade house grows. They're 36 hectares or 3.6 million square feet of pepper production annually. We started out with a university study with them, moved on to a commercial feasibility study, and have now sold them a commercial system for 1 hectare. And as they roll that out, they'll start to, over the next 3 to 5 years, roll out to the other 3.5 million square feet that they have under cultivation with their technology. And there's certain things that make us unique. We are the only people that can dissolve this type of level of CO2 into water in a bubbleless format and mist it onto the plant due to the patent portfolio we have. We definitely reduce protected ag's ecological footprint as they're no longer venting CO2 and they're able to make use of small amounts of CO2 to see increased yields. The fact that we naturally increase their pathogen protection means that they've got less crop loss every year. A recent customer of ours in the UK, who's a tomato grower, the main purchasing decision behind that was that they were experiencing significant crop loss in their highest value tomato. They did have some tomatoes that were pathogen resistant, but they get about 25% of the margin on those tomatoes that they do on the other ones. So the driving factor was us being able to keep the high value tomatoes alive so they could get them to market. And then the largest greenhouse markets for us, as we are in Canada, we do focus somewhat there, but if you look at this map, the US has twice the covered space that we have. Mexico is 12 times. Brazil with over 3 billion square feet and Spain with over 5 billion square feet. So that's why we focus on some of the areas we do, simply because most of our customers are located there. So again, low-hanging fruit for us. There's 600 billion square feet of protected ag. Which produces about 300 million metric tons of food annually, or about 1.2 trillion US dollars. 99% of that market cannot currently enhance their growth yields with atmospheric CO2, simply because they are open and they're not sealed and there's no way to bring CO2 to bear. We're the only solution they've got to get CO2 to their plants. And so we enable all of these growers to get the same benefits as someone with a high-tech, high-cost sealed greenhouse, which is upwards of about $2.5 million an acre to put in, versus thousands of dollars an acre for a covered grow. And if all of these growers were to uptake our technology, we'd see another 100 million metric tons of food produced a year, which would feed about 500 million people annually. And as I spoke to people who are already using atmospheric CO2, it really comes down to the economics of sustainability. There's 8 billion square feet of greenhouses today that currently do use CO2. A great example of that would be in our own backyard in Leamington, Ontario. Most of those growers are able to use CO2. There is a cost for them to do that. On average, for every million square feet of greenhouse, you use about 2,500 metric tons of CO2. It's on an average cost is $500 per metric ton. 90% of that is vented out as they have to exchange air all the time. So we would save them roughly about $1.25 million in CO2 costs. And then if we do bring in a carbon tax here in Canada of up to $170 per metric ton by 2030, which is what the Trudeau government has proposed, we'd see another $400,000 or 40 cents per square foot of operating costs added to all those greenhouses annually. So I think that we will be a great solution even for those high-tech class greenhouses that are currently gassing in CO2. How we market this technology is that we partner with people already located within the ag space and with a lot of agricultural background. So we deal with growers, we deal with people who sell synergistic technologies to growers, and we have them out in the field in areas with an abundance of grow. We also do trade shows, customer referrals, online marketing to support those efforts. But for us, it is really a feet on the ground sales force out visiting growers and being on site and seeing what their needs are and what we can bring to bear for them. We have a very simple revenue model for the company. We base our pricing on the area of cultivation that we install. Prices range from $1 a square foot for huge operations in the millions of square feet to about $10 per square foot for urban grows and high yield crop urban grows. So the difference would be something like peppers or tomatoes versus an urban cannabis grow. So it is simply economies of scale on square footage there. And our pricing includes a commercial technology site license that is utilized only on that site. If they decide to expand outwards, they need to get another site license. It also covers the cost of infrastructure, misting equipment, and infusion equipment that we supply to the customer. We have flexible terms. Some are straight up purchases, others are long-term leases, and sometimes lease to own. And so we bring a high ROI to our grower customers and high margins for CO2 Grow. Along with our commercial expansion, we are constantly doing R&D work. We work with St. Cloud State University in Minnesota, and we focus on projects that facilitate market expansion, that reinforce our existing patent portfolio and add to that portfolio. And all of our research activities are aimed at meeting our strategic expansion needs. So here's a quick graphic on it. We start in the lab in a pure research setting. We then blend research with demonstration projects with key customers. From then we work on expanding those things into full-scale commercial settings at those customers, leveraging the success there to capture new customers within the market space. And we do that both regionally and by crop type. Some of the key patents in our portfolio that help make us unique and keep us unique is our increased plant growth through dissolved CO2 foliar misting. That is likely our key patent. Our pathogen perimeter protection patent is another thing that I alluded to in the presentation on crop health, as well as metabolite enhancement. As I mentioned, we are an early stage commercial company. 8-month growth this year, we went from 30 million square feet of feasibility work to 200 million square feet. Revenues since launching commercially are sitting at close to $500,000 this year. And 2022 goals, we're looking to expand that to the range of $1.5 to $2.5 million in pure commercial sales within our target markets. We are a natural ESG leader because of the basis of our technology and what we do with lowering people's carbon footprints. We help create more food production to feed our growing population. And because of the way our technology works, it naturally promotes local food sustainability and security. We grow healthier plants naturally without the use of a lot of pesticides, and we are lowering protected ag's ecological footprint, and protected ag or covered ag is increasingly becoming the major driver of food for our population. We focus on people, planet, and profits. To speak to our cap table, we have about 84.5 million shares outstanding, 11.5 million warrants, all of which are owned by Osprey Ag Science and our management group. We have some options outstanding and fully diluted cap table of just over 1.2 million shares. In conclusion, we're a unique and proprietary technology. We have a potential market of over 600 billion square feet. We bring critical benefits to our customers, i.e. yield increases and crop protection and speed to market. We lower CO2 use, and we create more CO2 sequestration by higher plant uptake of CO2. So we take something like CO2 and turn it into more food. We have an extremely long and sustainable revenue growth runway as we're an early stage company. And again, the market size for us is phenomenally large. I think the CO2 Grow is a compelling investment opportunity with a strong ESG component. We have the potential to deliver significant returns for our investors. Thank you very much.
Thanks, Aaron. That was great. Yeah, interesting to see, I guess, how many trials that you've done and on a wide variety of crops. So I think it seems like the technology has been validated across a number of different crops.
Mm-hmm. We are currently working on roses in Colombia as part of our floriculture. That is our newest trial that we have underway. So, and we're working there with Lindy or Praxair as our commercial partner. So they're very interested in how we can deliver their CO2 to a grower customer of theirs.
Are you finding a lot of variability between the performance of your product on different crops, or is it pretty consistent?
We're seeing consistent results as far as yield increase and pathogen protection. Some crops react differently as speed to maturity. Some it seems to impact more than others. And then obviously it depends on crop life cycle. So some things like microgreens have an extremely short crop life cycle, i.e. they're sort of planted to market in 2 weeks versus things like peppers, cucumbers, and tomato plants, which they keep for an entire annual season, then strip them out and put new ones in every year.
And I recently saw some a press release on the South African agreement about macadamia trees and the ability to reduce that growth cycle by a year or two. Can you elaborate on that study and what the implications are for that?
Yeah, they have it. It's very interesting as it's almost a totally different market for us in that it's a partially covered crop, and eventually it becomes uncovered. But sort of in the nursery stage where they're growing those macadamia trees, it's sort of 10 years between sort of planting to first harvest. So they've got a misting infrastructure put in place as well as a covering to protect them. So they're looking to see if they can reduce sort of time to crop by about 20% or 2 years, which will reduce their investment significantly.
Yeah, I think something like that would have a significant ROI for a company. So,
Yeah.
obviously be very valuable.
Yeah,
Um,
it's a long-term study, but I'm very interested to see what happens with that.
and what are you generally experiencing in terms of length of sales cycle?
It really, the previous speaker alluded to that with the ag space, and it really depends on what crops people are growing. So, as an example, here in Ontario and Leamington, a lot of those are 3 and 4 generation farms, even though they're covered grow. So their decision-making process is a lot different than, say, an urban grow, like a cubic farms type company that says, hey, we're turning these things out right away and we turn over crops very quickly and we've got some investment dollars, so we'll adopt the technology today and pay for it. Whereas what we do with a lot of those older growers is we do commercial feasibilities and say, try it out on a small percentage of your crops and look at the difference. Use your standard crops as a control. Then we can figure out what the ROI is and how we roll it out with you over time. So it's a couple different models that we use to get in front of those type of customers.
It was interesting in Steve's keynote, he showed a chart of the growth of the plant-based protein market. Have you done much work in that space? Because I would think that would be a huge growth area as well.
I think it will be. I think our immediate focus is on high value foods, which are still vegetables for us, like peppers, tomatoes, berries are very high value crop for us versus the proteins. I'm sure that'll come to play down the road. I saw a recent commercial for Wendy's that talked about the lettuce on their burgers versus their burgers and how it's all grown in greenhouses, and that really made me sit up and listen to that as they were talking about a plant versus a meat. So.
Yesterday, we were chatting about some of the government changes and implementing taxes or implementing a carbon tax. Obviously, this would have some significant implications for the company. Can you talk about what the Canadian government is doing and how you expect that to impact the business?
Yeah, for our market here in Canada, as I alluded to with the cost per million square feet, if someone is making $3 of revenue per square foot on a million square feet, and they have a 20% gross profit margin, they're making 60 cents currently. If you bring in a carbon tax of $170 per metric ton, that works out to about 40 cents per square foot. So that's 2/3 of their gross profit margin chopped away right away in increased taxes. So what we can bring to bear there is obviously not paying any of those taxes because they're sequestering all the carbon, but also reducing their cost of CO2 by only using 10% of what they're currently paying for. So it's a very compelling profit story for grower customers.
And obviously that's something of great interest for these growers. What do you think the primary drivers of your business are? Is it this ESG perspective? Is it just increasing yields and profitability, or combination of everything?
The two things naturally go hand in hand as you increase food yields and increase crop security and sustainability. It's a natural on the ESG side of things for us. We don't focus on one versus the other, as they're so intertwined for our business.
And then you've obviously done a number of feasibility studies this year. How long do these studies typically take, and what do customers need to see in order to convert from feasibility to contract stage?
It really depends on the case study I spoke to about the large customer in El Salvador, that went from university phase, so sort of 6 to 9 months there. And then what they looked at was, hey, that was successful. We want to try it out. And it ran from, autumn through late spring. So I would say, 7-month commercial feasibility. So they could go through a couple of crop cycles and validate the 20% increase they were seeing in their yields. And it worked out to about an 85% increase in profitability on that section of their greenhouse. So they then made the decision to move forward commercially in 1 hectare, and that they've got another 35 hectares. So they're going to utilize the increased profitability to help fund the expansion through their entire facility. And what's exciting for us is we try to always obviously leverage those successes, and they're a contract grower for Lippman Family Farms, who's one of the largest producers of food in North America.
That's amazing. Yeah, I'm interesting to see how all these studies turn into significant contracts. Can you summarize before you go some of the main catalysts and news flow that investors can expect over the next 6 to 12 months?
I think that we're going to see more and more feasibilities and more graduation from commercial feasibilities to commercial sales. I think they're going to see more market penetration and more large name growers that they will recognize as customers that we'll be able to speak to.
Okay, great. And just before I let you go, in terms of the share structure, what's the retail to institutional percentage right now?
I think it's around 20%, close to 20% institutional, especially with those, if you factor in the warrants, and then we're still north of 20% management owned.
Okay, great. Well, thanks for the presentation, Aaron. Really good to get caught up, and I've been following the company for a number of years, and it seems like every time a new feasibility study comes out, the data just keeps getting better. So it's fantastic.
Well, thanks for having us, and thanks for your continued interest, Tina.
Good to see you.